Ravi, good having you. Thanks so much for taking the time out. Give us first a heads up on the top line. We'll come to the bottom line as well. But revenue is up 18% ahead of estimates, and realizations have been in line as well. Satisfying on that front?
Oh yes, I would say that realizations and the margins have actually increased extremely well. It was 68% Q2 to Q2, and it has actually gone up to 76%. And this is also because of the more and more utilization of the Westport mechanization. And therefore, yes, we are extremely happy with the margins as such. Even otherwise, in terms of the revenues and the cargo numbers, we are very pleased because as compared to the rest of the ports, which have actually registered a mere 1% growth, and also in containers and some places, in some quarters, actually a negative growth, we have had a 15% growth in cargo over the quarter, and also 12% over the half year. So yes, we are pleased with this performance.
Correct me, Ravi. I mean, I thought that the cargo handling of around 3.7 MT was on a YOY basis just about flattish or a little bit lower, as Abbott hasn't performed as well as you would probably would have liked it to.
Okay, let me put the numbers in the right perspective.
Sure.
On a consolidated basis also, we have done about 25.47 million tons. And that is also an increase of 15% YOY. And on a standalone basis, we have done 20.47, which is again a 15% growth. So yes, Abbott Point has done about 3.974 million tons. However, that tonnage there is not exactly relevant because we have a take-or-pay arrangements, and therefore in terms of the profitability, both the top line as well as the EBITDA, you would still have the entire take-or-pay revenues coming in. And therefore, though there may be a decrease in the cargo which is handled, the revenues and the EBITDA is still maintained.
Right. What's the outlook on your profitability then going forward? Because we have seen profits drop by about 4%. What's the call on that? And what would be the key drivers for growth from here on?
Yeah. First of all, on a standalone basis, the every parameters, whether it is the EBITDA, which has gone up by 57%, or the PAT also, which is in the last half year has gone up by 61%. What has remained flattish, as you say, is on a consolidated basis, including the Abbott Point, which came in this quarter with a 50 million tons capacity fully capitalized, and therefore there was a depreciation burden as compared to the previous quarter, which was not there, and this time it is there, and therefore in terms of the PAT, there has been a flattish one. However, going forward, as you rightly put it, in terms of the profitability, both the EBITDA margins as well as the PAT margins are not only expected to continue, but as and when we start having the coal handling at the fully mechanized terminal, we shall be doing better and better. And therefore, whether it is the cargo volumes that we have, or the EBITDA margins that we are registering, or the PAT, we do believe that in the quarters to come also, we'll be able to maintain this.
In fact, so that was going to be my next question. Also want to figure out about how the debt situation looks like, but before that, just an outlook. H2 versus H1. One, the kind of cargo handling or the volumes that you would do at the port, consolidated entity as a whole. How do you see H2 shaping up vis-a-vis H1?
Yes, and as you know, we normally don't give exact numbers in terms of the guidance as such, but then the way the H1 has performed and H2 is likely to be, and I think in every year we have seen H2 doing far better than H1. So if you can continue to go on the same premise, in the H1 we have done about 36 million tons, and even if you double it, it's around 72-75, but actually I think we should be doing much better than that. So H2 should be a better half than the first.
Okay, and one clarification, Ravi, that I was speaking to a few people who are also seeking there's been a sharp increase in net debt and short-term loans and advances, both at a standalone entity, if I'm not wrong, and consolidated net debt also has gone up. Now, is this essentially because of deployment of around 400-500 crores in intercorporate deposits and the remaining as advances to Hazira and other ports, or is there more to it?
No, actually I think your analysis and your analysts have done a very good job. It's precisely because of that. The debt has actually increased because of the capital expenditure, as we see that the gross block year on year also has increased significantly, and we have just implemented the doubling of the railway line at Mundra. We have completed the third container terminal. We have completed the mechanization of the coal berth. So all that also has led to the capital increase and therefore the corresponding debt. But other than that, the advances are, yes, there has been money which was lying around on the 29th of September. So there is some intercorporate, and yes, there's an investment in our various subsidiaries, which has been the way we have been running the SPVs. Effectively, they're all 100% subsidiary and fold up into the main.
What about revenues coming in from the SEZ? How will that be accounted for in H2?
In H2, it's difficult to say exactly how much, but I think we should be able to do a good job as much as we have done in H1. In H1, we have actually had about 250 crores. And we hope to continue that. But as you know, in SEZ it's quite difficult to say because it's a little lumpy business. Sometimes it comes up with a sudden surge, and some quarters can be absolutely barren.